Good morning to all of you free subscribers to Ironside's Macro. Our note this week was titled Fiscal on Fire. There were four sections to the note. We reviewed the first quarter and with a little bit of a preview of our outlook for the second quarter. We then went through the GDP report. Typically, the second revision to GDP wouldn't be all that interesting, but in the fourth quarter, it takes time for BEA to get all the corporate data together to provide their first estimate of GDI, which we consider to be a much better measure of the business cycle, albeit it's not as reported on as timely a basis as GDP, and their first measure of corporate profits. And there was some very interesting information in there. We then went on to discuss Fed Governor Waller's speech at the Economics Club of New York last Wednesday that we reviewed, and what we would consider to be misunderstanding by the Fed or misappreciation, underappreciation for the effects of their balance sheet on the level of longer term rates and volatility, and then wrapped it up with our outlook for this week, which is, this to us is a very pivotal week for the outlook for the second quarter because of the employment report on Friday. So first, we characterized or titled the first section, as Party Like It's 1995, because that 95 analog that was part of our bullish outlook a year ago, the markets very much looked like 1995 over the last two quarters, where back in November of 94, the Fed did the 75 basis point rate hike, and then the market never looked back. It barely had a consolidation, or did not have a consolidation, until the first rate cut on in July of 1995. The market just kept going, lower left to upper right. It then paused for a time and then kept going higher as the big tech boom was just getting started. In a lot of ways, the first quarter looked like that, with one key difference, which is the deep inversion of the yield curve. In 95, small caps kept up. Banks actually outperformed most other sectors. That didn't really happen this go around. Big banks kept up. Small banks lagged badly. Small caps lagged badly, and that's because of the deep inversion of the Treasury curve. When we were writing our outlook for the first quarter, we expected a growth scare to unfold in the first quarter, with our second most likely outcome that we'd get something of a bearish steepening, with the back end of the Treasury market moving up, because we thought the rally in Treasuries was way overdone going into the end of the year. We got a version of the latter, but still, we do think there's a very good chance that we'll get that labor market weakening that then gets the Fed started on our quadrilemma path. The idea that they could cut to 4, disinvert the curve in a benign way that wouldn't cause any more damage to bank balance sheets, keep the 10-year note in the vicinity of 4. If the unemployment rate goes through 4, it's going to need to happen in the second quarter, and wage growth falls decisively below 4. That's what makes this report all that much more important. We did see flat hours worked in the first 2 months of the year, but the Fed remains focused on those headline payroll gains, which are running at about 260,000 a month, far too fast for them to be cutting rates at this point. Inflation ticked up as we expected. That's not the burden or the hurdle for them to cut. It really is all about the labor market in our view. So moving on to GDI and GDP. GDI accelerated to 4.8% from 1.9, 6.6% nominally. That's driven by the net operating surplus of private enterprises, which was up 13.3%, up from 4.6. That's after 3 negative quarters. The real driver of stock prices and multiples in the first quarter was this decent recovery in corporate earnings. Put a little bit more flavor on that. The corporate profits measure from the BEA was up 5.1. That was driven by a 7.7% increase in domestic profits. Rest of the world was a far more tepid 2.8, and financial sector contracted by 4.6%. That underscores our broad outlook here, where yes, we're having an earnings recovery, but with a deep inversion of the curve. The broad banking system is struggling with this, and that's impairing the supply of credit to small businesses. real estate, and even the federal government. So the Waller speech misunderstanding of the effects of QE and QT, he described QE as putting out a fire, but QT is not restarting the fire. The entire analogy doesn't make any sense because they're so passive with respect to how they do QT. So for example, there's three channels to QE and QT: liquidity, duration, and vol. From a liquidity perspective, the Fed was buying 80 billion of treasuries, buying 40 billion of mortgages, and reinvesting 55 to 60 billion per month of mortgages in 2021. That's 180 billion of liquidity. Right now, they're only subtracting 75. That's not symmetrical. From a duration perspective, they were taking 180 billion out of the market. They're only getting 16 billion in mortgage pay downs. And from a vol perspective, they were taking 100 billion of mortgages out of the market, and now they're putting 16 billion of low coupon, low delta mortgages back into the market. None of that's symmetrical. That is putting downward pressure on long-term rates and misallocating capital. We don't understand why the Fed doesn't believe that. That's why we titled that section malinvestment, never heard of it. It just doesn't make any sense to us. So big week this week from a labor market perspective. Our paid subscribers will be getting a labor market preview note on Tuesday. The free subscribers, you'll be getting the first couple of paragraphs of that. Please consider becoming a full paid subscriber. If you want a trial, by all means, let us know. We're happy to give you one. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.